James, the mood music has changed so radically in the last 2.5 months, it begs the question whether these central banks have been wrong-footed.
I think we have to recognize that the volatility of the underlying data is immense. And what we're seeing right now are significant knock-on impacts. Whenever we get a surge in virus statistics in any particular country, we get mobility significantly reducing. That then impacts both the broader services sector, but also consumption in a very direct way. In addition, on the unemployment side, the critical thing, and we've talked about this in prior programs, the critical number to watch here is not the unemployment rate. That currently sits within 20 basis points of pre-COVID levels. The more important statistic, however, is the participation rate, which is still lower than what we saw historically. And the million-dollar question there is that demographic, or has that been triggered by things like stimulus checks in the United States? And so to be fair to central banks around the world, we are operating in an incredibly complex environment.
So what is it then? I mean, is it generally demographic, or is it those stimulus checks ultimately?
I think what we're seeing right now is an improvement in the outlook for global growth, and I think that's an important backdrop to the conversation, as well as recognition that we have structural drivers of inflation across a range of characteristics. If I think about the global growth outlook, it is important to note that despite the fact that investors have shed equities at their fastest rate since early 2020, we're now actually sitting at a pre-crisis PE level in major market indexes. The outlook for growth looks actually quite strong. We're looking at both corporate as well as private balance sheets that are in their best shape at this stage of an expansion that we've seen in years. On top of that, we obviously have structural drivers of inflation as well. As we start to move to a green economy, what we're seeing is the reduction in supply for oil exploration, things of that nature, is occurring far faster than replacements are coming on stream. That arguably is not structural, that's tactical. It will take several years to work through. But we do see these structural drivers across several elements of the economy. You put the two together, however, and we do see a more constructive environment for equity performance than perhaps we've seen on a year-to-date basis in the actual movement in stock markets.
James, let's look at yields, rising yields. We have Japan's JGBs 5 years above zero for the first time in, 6-7 years. We have the bonds rising overnight, and that's prompting some to say that if that continues, we'll see Treasury yields, 10-year yields at 2 or above this year. I'm wondering how this is all going to play out in the equity market.
Haslinda, is a great question, and I would approach it from two different directions. Number one, as discussed at the top of the program, you have clear upward pressure on rates across a range of central banks. At JPMorgan, as Kathleen noted, we brought forward our estimate of an ECB hike to December 2022. Previously, we had been forecasting March. The commentary out of the Bank of England was incredibly strong. Again, as noted, 2011 was the first time we had any votes for a 50 basis point increase. This time we had 4, and we are taking forward some of our rate increases for the Fed in the United States as well. So against that backdrop, it's right to look at rising yields. It's right to look at rising rates going forward. The interesting element of that from an equity market perspective, however, at JPMorgan, our analysis is that equity markets can clearly stomach long-term rates in the U.S. of 2% or slightly higher. That will continue to trigger these rotational trades in the market. We've seen some degree of rotation out of growth and momentum and into value. Within the tech space, right, and I think this is absolutely critical, you are seeing significant rotational trades based on changes in business models, which is, I think, an incredibly important thing to talk about.
James, finally, I'm just wondering as well, I mean, will the first 3 weeks of 2022 be a reflection of what's to come for the rest of the year?
At JPMorgan, we don't think so. We see equity markets as washed out from a valuation perspective. We see investor positioning as extremely light. I would note here in Asia, China continues to be the largest underweight for most investor portfolios. Investors started to dip their toe into the China market over the past couple of weeks, and we're obviously seeing strong kickstart to the day in Hong Kong. But we do see opportunities forming for bottom fishing, particularly in cyclicals, particularly in emerging markets, and particularly in China.
James, I want to just get over to the geopolitical overlay. $100 a barrel for WTI. If we get to that, does that change the game entirely for not just central banks, but actually the consumer?
So it's an interesting dynamic. As we just discussed, I think we are seeing very clear drivers of that increase that are non-geopolitical in nature. The impact of climate change from a short-term perspective are higher energy prices overall. That's arguably a positive from a climate change discussion perspective because you're encouraging the development of renewables. You're giving a greater price umbrella for some of these alternative energy sources. So arguably better for the long-term discussion on climate. You add to that conversation, however, some of the geopolitical conversations, particularly in Europe, that we're seeing right now. And we're wondering how that will play out on a short to medium term basis. I think the critical element of this is that most central banks continue to look at core CPI, which excludes energy, excludes food. That reduces the volatility of the inflation outlook significantly. I think the longer term question for central banks, and it's a longer conversation for perhaps for another day, is the fact that climate drives food, climate drives oil and gas prices. And so effectively, central banks are arguing that we need to ignore climate impacts on inflation. That's a dangerous long-term assumption.